Negative GDP growth in the US in the first quarter. The greenback is at its weakest since 2022, and my guest is very bullish for a certain precious metal. We'll talk about that in a few short seconds. And let me do the intro properly. My name is Kai Hoffman. I'm the JR mining guy over on X, and of course, your host of this channel. Welcome to Soar Financially. And it is my pleasure to introduce a first-time guest here in a few short seconds. It's Jaime Carrasco. He's a senior portfolio manager over at Harbourfront Wealth Management, and I'm looking forward to catching up with him and really discuss what is the macro situation out there. Lots of things happening, and a lot of skittishness, let's call it that, out there as well. A lot of investors are fleeing long-term bonds, and the question is, why is that? So lots to discuss and lots to talk about. Before I switch over, hit that like and subscribe button. It's a free way to support us, and we tremendously appreciate that. So Jaime, thank you so much for joining us. It's good to see you.
Thank you very much. Thank you for having me for the first time. Looking forward to our chat.
Absolutely. Yeah, lots to discuss, lots going on. We got a bit of macro data today as well. But before we dive into some of the specifics here, Jaime, run us a bit through your understanding of the current macroeconomic picture of the economy and the financial markets.
Well, I think that to answer your question right off the bat, and the answer to your questions with regards to this topic, and the word is trust. The trust. Are global investors wondering if the funds that have been lent, that they've borrowed or lent to the US government will ever be paid back to any government? We're talking about trillions now, right? And trillions. One of the problems that I see is that people do not fully understand what a trillion is. You know, back in 2008, we were talking billions, now we're talking trillions. It's just another zero. But what it really means, every trillion is one generation will never be able to pay it back. And that's happening globally. So I think what we're witnessing right now is the end of a credit cycle that has been building for a long time. Since Nixon and pegged in 75, we've gone into this massive debt expansion that is historical by all means, right? And now trust is setting in that, well, maybe we will never be able to get that money back. And you know what? Math says it won't, because we have more debt than can ever be paid back in generations. And because of that, I think that is what I'm looking at, because we're in a situation similar to what was happening in the Americas, Latin America, through what has always happened through history, when credit goes awry, when governments start to believe, as they did in 2008, that they can fix a debt problem with more debt. And all we've been doing is piling in the debt. And so now, through history, when we get to that point, we have to go back to some kind of a reset. And that's why, as history dictates, and as Ray Dalio said, if you don't own any gold, you don't know any history or economics, because gold is money and everything else is credit. Everything has been funded with credit. And when credit implodes, we have to go back to that ultimate form of monetary trust, and that is gold. And that's why central banks over the last number of years have been buying like crazy. They know it, even though they get their minions, the local banks, to tell us that it's a pet rock or a barbarous relic, so that the average person, you know, never even thinks about it until it's too late. You know, at $1,500 gold a couple of years ago, now we're at $3,300 gold US, almost 5,000 Canadian, right? So it tracks better the devaluation or the purchasing power of the money. And one last thing, in today's world, we're living in the fiat world, which means that all money is backed by the word of some politician or some banker, right? And in that environment, nothing's pegged to anything tangible like gold in the past. And because of that, what we're really witnessing is the end of a system. And there we can find historical parallels that say to us, well, why you want to have some gold? The GDP number that came out today, what we're noticing is stagflation. And that is, again, another reflection of a credit bubble bust, just like in the 80s, where credit is overwhelming the system. So you're not going to have much growth, but you are going to have inflation in the things you really need, which we're seeing because it's the purchasing power of money that is devaluing.
No, lots going on, as you said. Like, I need to follow up with a few things here that you mentioned, Jaime, absolutely. And maybe the last part is, or maybe the first thing you mentioned is debt. And how do you get out of debt? Well, you usually grow your way out of it, or you can, is one option. And right now, the US is growing at a negative pace. Minus 0.5% is the revised number down for Q1. Doesn't look that rosy, does it? And you use the term stagflation in that regard as well, which put Jerome Powell in the hot seat, although he didn't use that word. He just used the description of it. But we got to talk about that. U.S. economic growth. Where do you see it trending, and why is it negative, and how can we sort of turn that boat around?
Line, let's think about this. You're going to grow your way out of debt. There's no way that the U.S. economy, as big as it is, can ever grow itself out of all the debt. 37 trillion on the federal government. What about the provincial, the state government, and the local governments? So we're talking about over 200 trillion. And never mind Medicare, Medicaid, Social Security, as the population's getting older, right? So because of that, I think it's better to assess the system the way that I see it. I see it as the global Titanic, and the water that's coming in is credit, and it's getting overwhelming, right? And because of that, I'm a realist. I think the system is going to sink, and governments never default, by the way. They devalue, which is exactly what Roosevelt did in 1933. Devalue the debt in the old currency against the value of a repriced asset in the balance sheet, which is gold, to a higher level and create a brand new pool of money. So by devaluing and creating another pool of money is how they've always done it. And Scott Bessent has already signaled that that's what they're going to do again, but nobody's listening. I am, because I like history, and he's telling me, hey, we're going to do exactly what we did in the past. As for economic growth, the problem is that in that environment, interest rate expenses continue to grow, right? So think about it in your credit card. You're fully loaded on your credit and everything, and your interest rates are going higher. You can never make up that money as a citizen. You will never, you never will, right? So again, as an individual, you have choices, and it's about making the right choices. And that's what I try to help people with within my practice, by looking at it from the perspective of what my family did in Latin America. I'm from Chile. I was born in Chile, ended up in Canada as a young man because of a lot of what was happening in Chile. But much of my family did survive through the economic crunch of the 80s and 90s by making the right choices. And I think those choices are constant throughout history. And, it's how do you position yourself to benefit or protect yourself from what is actually happening around us.
You said something interesting. Like you mentioned Scott Bessent hinted at a potential devaluation of government debt. Let's run it.
Not of government debt, or the asset side of the ledger.
Okay.
Right. So think about it. The balance sheet of any government has only two things: debt on one side, the liabilities, and asset on the other. That asset is gold. That's why central banks around the world are buying gold. That is the only asset that a government controls. So he who controls the most of that asset sets the rules, the number one rule of power, because he who controls that asset also always tends to have the military power to control and keep that asset, so they can revalue the asset by, in 1933, going from $7 to $35. This time, we're sitting at 3,000. It's not enough on 8,000 tons. And actually, we have some hints on that, because Judy Shelton already mentioned something. What was her solution to the problem? Create a brand new pool of money worth 50 billion over. 5 trillion paid back over 30 years, backed by the gold reserves of the US. Well, that makes a lot of sense, because it's exactly what Roosevelt said. But if you do the math, every ounce of gold has to be at least $20,000, right? So what are they doing? They're in essence setting up a brand new pool of money with gold to devalue all of the old debts in the fiat dollar, and you go back to some kind of a gold-backed monetary system.
Yeah, I think you need $142,000 per ounce to sort of back all the U.S. government debt. That includes Medicaid, Medicare, and all that, right?
Gold, so.
Yeah, right. But the question is, what are the ramifications if that were to happen, right?
Well, the ramifications, I think it's important to understand that people's Medicare, Medicaid, Social Security, you're still going to get that $1,000 worth a month, but it's only going to buy you about $100 or less, right? Because it's money that is devaluing. On the other side, though, what are the benefits to the government is they're going to have a $5 trillion pool to do their MAGA plan. And what is MAGA? Rebuild the U.S. go back to the old economic paradigm prior to the 80s when the US started sending everything offshore to be produced cheaper outside of the US, funded with US debt, right? Well, we can't fund things with US debt anymore, so now you got to go back and rebuild it in the US, but you need the money to do it, right? So where's that money coming from? It's a brand new pool of money that gets set up. And by the way, that's exactly how Roosevelt paid for the whole New Deal, starting in 33, coming into the Second World War, and ending with a full reset of the system by Bretton Woods after the Second World War, right? It allowed the U.S. to build the infrastructure for the U.S. again and to set up its manufacturing base prior to entering the war.
No, it's an interesting topic, Jaime. It's like I love history lessons as well and trying to understand all of that, because probably later on we'll talk about Smooth Holly as well. We got to talk. We will have to touch on it, but we got to get back to stagflation. At least the definition of the term. It's rising inflation and slower growth. We've talked about the growth side of things. Let's talk about the inflation side of things, which will probably lead us to a history lesson here about Smooth Holly.
Actually, no. That's a simple answer, because what is inflation? What people don't understand, they think that inflation is that things are going up in price. It isn't that my banana is getting more expensive. It's that the money by which I'm buying the banana is losing its purchasing power, right? It's the money that is devaluing. So it's the two components, because money is devaluing because its purchasing power is decreasing, because central banks have to start printing way more money to buy up the debt as a continuation of the debt trap that they built for themselves. It's always the same mechanic. And because of that, the best hedge for that is gold, because that's outside of the monetary system. It's a single asset that no matter what's happening to the money that's being printed, that's holding its purchasing power. Now, a lot of other things are going to hold their purchasing power: energy, all hard assets, things that you got to bring out of the ground, right? But they depreciate. Gold is the ultimate because it's controlled by the banks, and then silver comes behind because it's kind of like a blend, which is accessible to the average citizen, not the big wealthy people and the governments, right? So that's why silver and gold are always interconnected in that environment.
Based on what you just said, Jaime, is like M2 money supply has been increasing again. Like we went through a bit of a valley and now we're coming out on top. We're almost at record highs here for M2 money supply. Is that what you're talking about when you mean
exactly?
Inflation?
And I would argue that it's going to have to go through the roof, because nobody wants to buy U.S. credit, right? What is happening to the 30-year bond? The 30-year bond crossed 5%. We're at 484 now, right? The 10-year bond was at 450. Now it's below. It's about, 440, 435, something like that. But interest rates are going higher, not because people want that, it's because they're selling it. Global players are selling U.S. debt, and who's left to buy? Central bank, right? The U.S. government itself, because they're the buyer of last resort. So eventually, I think that the central bank is going to be forced to start printing money, kill interest rates on the short end, which is where they lend money overnight to the banking system, right? It's not where you and I have access to credit. It's the players within the system. But that's going to invert the yield curve, because all they're doing is printing money to buy debt that nobody else wants, right? And so that mechanic always plays out. And it's inevitable that the U.S. now is in that boat. And so what it means, though, is that the interest rate expense is only going to get more expensive as the purchasing power of the money up front is reducing at an even faster pace, right? Because these things tend to accelerate and go exponential. This is an important thing to think about. So the low on the 30-year bond was 0.74. Call it 1%, right? That was in 2020. At the same time that gold hit about 1450. Okay. The 30-year bond has gone from 0.74 to the first double was 1.5. The next double is 3%. Now we're heading for the third double, right? So it's exponentially increasing. And what's important, if you look at the time frame of what that amount of time is taking, it's the same time frame. So the rate of acceleration is increasing, and that's how things go exponential. It's already happening, right? We are already on our way to 6%. Well, in the 1980s, rates hit 18%, and we had way less debt to GDP than we have now. So where are we going now? I personally think that the number's much higher. Maybe people are going to notice when we cross 10% this time. Who knows? I started preparing way long before that on the way down. And the fact that we will never see below 1% 30-year bonds again, I think is important, because it's also, it's a clear signal that that was the bottom for interest rates and the high for the bond market, which had been appreciated in value until 2020 when it hit that low yield. And now yields rising means that the value of the bond market is decreasing, or the value of the credit.
I think we need to get Ted more granular on like the money printing side, like what that means for Joe Blow, what it means for me or anybody that doesn't own gold, obviously. But like, how will that sort of show up? Like, it won't be the famous picture of Bernanke flying in the helicopter, throwing out money to everybody, or like the COVID injection of cash for everybody into their bank accounts. Like, what will that look like? Let's explain that just a little bit, Jaime.
Well, first of all, look at what's happening with copper. Copper's getting close to 5% now. The global economy is not growing at any fast pace. So is the demand for copper going through the roof? No, I don't think so. I think what we're witnessing more is the fact that dollar is buying less and less copper all the time, right? Same thing with gold. So it's the purchasing power of the money. How much can you buy? How much Starbucks coffee can you buy every morning? Well, a couple of years ago, the same cup of coffee was what? $2 US. Now, if I recall, last time I was in New York, it was almost $5 for a cup of coffee, right? So that's a double, right? And that continues to increase. So that's how it shows up. It shows up in the fact that things are getting more expensive, especially the things that you need. Now, you are getting deflation in the things you don't really need, like LCD TVs or things like that. But the things that you really need, medicine, education, care, food, those are getting more expensive. So you're losing purchasing power. Now, the one thing that people are also not fully noticing, you're still getting $15 an hour, but that $15 an hour of your labor is not really paying for as much as it was before, which is another way to see it is, why do households need two parents to be working to make ends meet? But in the 50s, 60s, 70s, one parent would do it for the same reason. Is that acceleration in inflation that now we're getting to that point where, the cost of living is so expensive that everybody's going to have to be working two jobs. Another great way to see it is how many younger kids that have already graduated, started working, have moving back with their parents because they can't make ends meet. So it's exactly the same thing that was happening in the world all over the place, but now it's happening globally and in the US.
Which is a scary thought, because I don't feel like moving in with my parents again, quite honestly.
Well, keep doing interviews like this, and you won't, because it's good work, because you're getting the word out that people have to pay attention, and I think people are beginning to understand that, hey, I got to do something. Now, my field of work is, how do people protect their assets? Because I think that's the important one. How do you protect all the savings that you've accumulated over these years from what's about to happen? And I think that's the one that nobody sees. Very few see it at the very end, on how to position yourself. And I can the main criteria for that is that there's a great chart out there that I post on a regular basis on both Twitter and my LinkedIn, where it shows the level of accumulation of the precious metal sector by institutions over the last 100 years, and in the 4 periods as we are living now. Through those periods, it was up to about 25 to 30% in the precious metal sector. Right now, it's about 1%. So it kind of shows me that institutional money, people in my industry, they don't know what gold is. They're completely oblivious, still tracking, their Nvidia and whatever is the hot investment of the time. But when it comes to gold and silver, they still don't get it, right? And the reason why I get it, and maybe they're starting to notice it now, is because in that environment of losing purchasing power of the money, gold and silver prices are accelerating higher, and the earnings of the companies are the only sector that is delivering earnings growth at a faster pace than anything else, right? This time last year, the cash flow margins of the precious metal sector was tracking 40%, even beating high tech. Well, I don't know if you've noticed where gold has gone from this time last year to now, and silver. So those margins have gotten even better. Well, they still don't know the one sector that they should have as a lifeboat. They're still, in my opinion, they're still listening to the music in the first deck of the Titanic. And in the meantime, those lifeboats are getting more and more expensive. In Canada, a couple of years ago, we were at par currency. So gold was at 1,500 here, 1,500 there. Today, gold is almost 5,000 because the Canadian dollar is losing power at a faster pace than the US dollar, right? And this is happening globally. If you look at the chart of gold in all currencies of the big countries, gold's doing this, is going parabolic, because it's not gold going parabolic, it's the purchasing power of all those currencies because they're all fiat.
Before we get too far away from it, I want to come back to the miners and gold and what's pushing gold, or what's keeping gold at the current level, of course. We quickly, because I touched on it earlier, we need to talk tariff and on inflation real quick, and then we'll get to the micro. Let's just put a bow around the macro here. What is your assessment of the tariff impact here, Jaime?
You know what? I personally think that the tariffs are the game changer for the Trump administration, which wants to go back to a mercantilist system similar to the 1930s in order to bring back manufacturing back to the US. It's kind of, the best example that I can show in today's environment is what's happening in Argentina, right? Look at the economic impact of Argentina, where he just cleaned up the government, got rid of the fat in the economy, which was government spending, set up a tariff-based system, and cut a VAT. I think the same thing is the process that we have begun, but it's a lot harder to do within the US. So the tariff impact, I think it's here to stay, and you can't get rid of it. But a lot of it as well is noise, because it's the art of the deal. Aside of the wars that are going on, if you look at the economic policies that are being placed, I don't think the tariffs are going away. I think it's the way that you got to transition to a new economy that's not based on a global-based system, but producing it at home and coming back. And in order to do that, one of the things is to offer a much lower cost of labor to produce in the US, right? And so the tariffs, I think the impact is going to be that they are going to slow down economic growth to some extent, but by the same token, it's going to transition economic growth. Because no matter what, we got to go through the economic pain, right? It's like going on a diet, right? It's going to hurt. You're not going to be able to eat your sweets, and, Ozempic is not enough for the economy.
No. Definitely isn't. Real quick, tariffs, inflationary or disinflationary?
You know what? I can't answer that. I haven't really thought about it to that effect. I'm not really worried whether I'm going to get wet or frozen as the storm hits. I'm more worried about it. Okay, how do I make myself comfortable in the lifeboat? More important to me than answering that question.
No, fantastic. Jaime, I really appreciate you answering that. Let's put a bow around the macro. Let's talk micro. Let's talk gold. Let's talk the other precious metal that you're extremely bullish on. And let's talk miners. Gold, 33.24 right now. It's hanging in there. Like, I have to admit, like, it is showing strength, especially given the fact that Iran and Israel seemingly are about to make peace here. We'll see where that goes. But what do you make of the gold price right now, Jaime? Explain it to us a bit.
Well, one thing, we're at quarter end. And every quarter end, they mess around with the prices so that they can roll over all these contracts. I think it's 75,000 contracts short silver right now that they're rolling over at a loss, because last quarter silver was much lower. And all the annual contracts, so you look at all those contracts, are rolling on at a negative. So we have a very big bear trap. I don't worry too much about the price. I think worrying about the price is unproductive. I think more importantly is to worry about my allocation that I hold in precious metals. Right, go back to that 1%. Right now, investors are underway lifeboats. They're overloaded in the music of the Titanic, but not in the lifeboats, right? And those lifeboats are getting more expensive by the day. So my advice has always been worry about your allocation. I started truly building my allocations in 2015. I was on BNN here in Canada, and I was sitting at a 5% allocation in my portfolios, and I started increasing it. Today, I advise people to have at least 30% of their portfolio in the precious metals, gold, producers, royalty companies, and any all the good investments. Not necessarily explorations, that's the real speculation, but the producers, the gold producers, were ridiculously priced for the last 2 years. Now they're getting more expensive. Silver is the next one because silver has to catch up, but it's about worrying more about your suitable allocation to protect your assets. Why 30%? From experience, having been a director for Scotiabank, I covered all of Chile, and I've been working through Latin America forever with my career. I can tell you that 20% was the minimum that a wealthy Latin American would have had to protect their purchasing power of their assets. The other 10% would have allowed you to speculate and benefit to be able to buy other assets, because you want to hold on to protecting your current investments, but you also want to benefit. I have a much greater allocation myself because I want to fully take advantage of what's going on. And what is happening really is a wealth transfer. It's a wealth transfer that always occurs as the purchasing power of credit shifts back to the real asset. So if you're sitting on the real asset, your assets will appreciate as the value of the real asset moves higher. And this is important to understand because it's not the value of your Microsoft stock that's going to lose value. It's the value of Microsoft priced in US dollars that is losing value. And in that environment, the value of gold in US dollars beats everything. Now, the catch up that silver has to have, I think, is going to be even greater. And that's why I think that silver will be the GOAT of investment, the greatest of all times, because of the current prices at a ridiculous disconnect.
That was my next question. Like you called it numerous times just the last couple of days, silver to be the GOAT. GOAT is a strong word. You know, if you look at sports GOATs, you know, like Tom Brady, Michael Jordan, those guys, like proper GOATs. Like what makes silver so GOATy?
I've been investing. I started my career in the late 80s, early 90s. I participated in the high-tech sector by managing the pension plan for Microsoft Canada starting around 1995. So I did benefit from the high-tech cycle. 2021, I was on television telling everybody, load up on Bitcoin. This thing is the future. Nobody, and that was at the bottom of that cycle. I bought my first Bitcoin at $5. So it's not as though I'm a gold bug. I'm investment agnostic. I'm just looking where the good trades are going to be. Why silver? Historically, the price of gold and silver has always been set by nature because there is a natural relationship between the two, in that for every ton of ore, of dirt that we pull out of the ground, we find 1 ounce of gold versus about 15 ounces of silver. Some people say it's as low as 7, others say it's as high as 30. Let's settle on 15. So the historical price reference of gold to silver ratio has historically been between 15 to 30, okay? It hit 100 3 weeks ago. That relationship has to come back for a couple of reasons. First of all, one of the problems is that the average person is finally waking up. The average Costco buyer, because that's your average person to me, is finally waking up to the fact that, wait a minute, when I go to Costco and I buy that gold coin, I'm paying $3,300, but I'm paying $37 at the store for silver. Well, maybe I should pick up the silver. So that's the substitution effect that takes place. But the beauty of silver is that it also has a monetary and an industrial component. And the industrial component, most people are dismissing because the price should have gone up, but it hasn't. It hasn't inflated. It's one of the few assets that hasn't inflated because they keep shorting the paper price. However, the demand has been going through the roof on the industrial capacity for photovoltaics, for electronics, for all kinds of things, to the point that if we produce, call it 1 billion tons a year, right now we have a deficit, a structural deficit that we're only producing about 700 million. So it's about a 30% deficit. Why? Because since the price hasn't gone up, we haven't been looking for silver mines. So the bulk of silver production comes from copper mines, from lead mines, from all kinds of other mines. It's a byproduct, right? So we have a structural deficit on the manufacturing side, but all of a sudden, people are finally waking up to the fact that they better get on the lifeboats. Those lifeboats are getting more expensive, but you have a silver raft at a much cheaper price right now. So the price is going to escalate as people start to figure it out, right? I was buying gold at $1,500. Now I'm buying silver for the last couple of years. I've just been adding silver because of the price differential, which has to catch up, and it always does. Again, that's history talking. Is it going to be different this time? Man, I love it when people think that things are going to be different, because it rarely is. History tends to rhyme, as Mark Twain said.
Famous last words. It's going to be different this time. Absolutely. You holistically described the silver space, and I don't think we need to follow up on anything in particular, but I do need to talk about the miners, because we're coming up, as you said earlier, towards the end of the quarter. And I haven't done my math yet, but VWAP for gold was 28.64, I believe, in Q1. It has to be almost $200 higher this quarter. It has to be, maybe even $300.
Even higher,
right?
So even bigger, right? So again, when I structure my portfolios, I love the miners because they have been for a while the cheapest asset to be owned, because everybody was chasing Nvidia, so I was able to accumulate. And now they're also starting good dividends, because the free cash flow that they're generating is huge. You have some silver companies, some of the silver miners, that have been paying off their debt within a year at a very fast pace because of the cash flow that they're generating. There's a private company in Bolivia that I'm happy to talk about because it's private, called San Cristobal, which had a 30% dividend last year, and this year is looking to be 50%, right? It's a massive cash flow generator because they're a very low-cost producer. Well, you're starting to see the same kind of things with a lot of these producers. And you think that $35 silver is great. Well, let's wait until we get to 60. And by the way, a $100 price is quite doable, because 50 is the all-time historical high. Well, and that's not even near the 100 on 3,000. That's, we're looking at still at a relatively high gold to silver ratio. So there's plenty of upside on the silver side. And that's why it's going to be the GOAT, because its price performance to catch up to gold, and never mind where gold gets to, has to run up much faster, much higher on a percentage basis. But then think about what that does to the earnings of the silver producers, which to me are beautiful investments that are going to be going for a long way. Now, you have to differentiate. I do advise that people seek the advice of an expert or somebody with expertise in this sector. And forget about the ETFs, by the way. Anything that's built with IOUs from a bank, they don't have that silver. All they've been doing is paper shorting it. Do you really think they're going to have it to deliver? What they've done is, through an ETF, they've made a promise to pay the performance of a certain index. Well, if that index takes off, don't expect your money. If you did in 08 and you're still expecting it now, well, caveat emptor. That's why I own the producers. I own direct participation in the producers. 4 criteria. Management is key, geopolitical risk, reserves on the ground, and cost of production, right? Then come the developers, companies that are developing mines that are not yet running, but those are going to benefit from the value of gold on the ground. Those reserves on the ground eventually are going to have a price, especially with blockchain. You're starting to see a lot of ideas come out that are going to give value to that reserve. And then you have then you have the royalty companies, which are a different animal. They're more finance companies that generate cash flow. And then you have the speculation, which are the explorers. Now, those are the fun ones, because those can add reserves very quickly through the drill by discovery. But the serious money should be parked in the producers, especially the ones that are already showing dividends. 2015, when I set up my portfolio, only 3 companies of 30 were paying dividend. Now we have almost 10. The last one that declared a dividend just got taken out by Pan American Silver, Mag Silver. That was a brand new dividend. That's gone. But even the silver companies now are starting to put out dividends. Now that's important, because that's a complete replay of history. 1933. Had you invested in Homestake Mining and Alaska Juno, the Barrick and Goldcorp of the time, an investment of $7,000 would have turned into $90,000 and paid you a $9,000 at 10% dividend from about 1935 right through to Bretton Woods. History is repeating. That dividend cash flow generation, because the monetary system is rebuilding, is already playing out. And that to me is great, because when I was mentioning that in 2015, I was just betting that history was going to repeat. Now it is actually repeating. It's being proven, but smart money managers in North America still don't get it.
It's an interesting one, because I'm looking at dividends, and I'm a bit torn whether I'm a value or a growth investor, or I'm a growth investor. I'm not chasing dividends personally. Because I like companies to reinvest, grow the production, not like Barrick where it's declining. And then the dividend yield. I was just pulled up a comp table here, and let me see if I can find it real quick, Jaime. Dividend
Well, bring
yield,
up Agnico Eagle. That's a great example.
1.3% dividend yield.
Sorry?
1.3% dividend yield.
Okay, 1.3% at US $105. What's it trading in US dollars?
Very good question. It's 166 Canadian times 1 point or
Canadian,
divided by
but that
1.37.
dividend yield was 1% when the stock was down at $60 a couple of years ago.
Yeah.
Because they keep increasing the dividend, but the share price continues to go up, right? That's the key. Is that it's the dividend growth component that a company like Agnico Eagle has a dividend payment that's based on revenue. So the more revenue, the more they're increasing the dividend, but the more the shares are going up. The same thing with Lundin Gold, the same thing with First Majestic, the same thing with MAG, right? So the dividend structure is different because these companies have their mind. Yeah, they're going to have to go out and purchase increased reserves along the way, which creates an opportunity. But I think you're going to notice that the acceleration in the price of gold and silver versus the acceleration in the cash flow generation is going to more than overwhelm their ability to go and buy more projects, right? So all that excess cash flow gets paid back in dividends. And that's what usually has happened throughout history. And I think it's going to happen again. And that's why I think this is one of the best setups, because nobody sees that yet. Everybody's still asleep at the wheel, in my opinion. And by the way, that's another historical parallel, because go back to the 1970s, right? I was taught the business by the guys that were managing the bond market, because I'm a bond guy. I'm not a gold bug. I was on the repo desk at Gordon Capital early on before they won Glass-Steagall. And it was the bond traders of that 70s and 80s throughout that whole inflationary period that taught me the bond business. But guess what? Gold was traded on the bond desk ahead of the US dollar, right? So to them, gold was the ultimate form of money. But coming into that period, you had the nifty 50s. Making money, participating on Wall Street was easy. You could throw a dart. But so everybody forgot. Then we go into the inflationary phase, and you had to become a stock picker again, right? So it was the stock picking that made it, because in that environment, not every sector is doing well, even though you're going to have some little stellar companies that are going to do well. So you got to learn how to pick them. Here's the problem with my industry, is that it's been very easy. The way that the financial advisors today, they're not thinking, they're just parking assets in pools that they don't understand what the hell's in the pool. And in those pools, there's hardly any precious metals. So it creates an opportunity to the contrarian thinkers that can be out of the box and start picking stocks. That's why stock picking is so important. And the problem is that those pools, if you start looking at the pools, they're built with ETFs, with derivatives. And that is where investors should be worried, because there's going to come a point when interest rates get high enough, and they are going higher. So don't think that I'm crazy on this one. When they get high enough, that it won't be about the return of capital, but the capital return, but the return of your capital. Because if that capital is the promise to deliver that return by a financial institution that could be broke, you got nothing. On the other hand, I have my shares, I own the shares, I know exactly what I own within my portfolios. That's why the stock pickers are going to come back to the fore, just like they did in the 70s and 80s. Peter Lynch, there's my hero of my training days, right? He always said it, you got to be a stock picker. Jimmy Rogers, another guy.
I really, really enjoy our conversation. I usually like to end it with a bit of a rapid fire round, meaning we play a game. We play a game of higher or lower. Okay. Really straightforward, quite binary. Inflation by year end. Everything's year end, by the way, so I don't have to repeat myself. So inflation by year end, higher or lower?
I think it's
no. Binary. Binary. There's no gray area. Higher or lower?
They them.
Killing me.
Let's go higher then. Let's go higher.
Gotcha. Fed funds rate.
Much lower.
Unemployment.
Much higher.
S&P 500.
Could be higher.
Yields on the 10-year.
Oh, much higher.
The Dixie?
On that, hold on. Keep an eye on the Dixie, which just broke 97. It's all about the dollar.
Yeah, that was my next one. Dixie, higher or lower?
Much lower.
Much lower. Gold?
Much higher.
And the last one is very rhetorical, silver.
Oh. Gold.
Absolutely. Fantastic. Jaime, really enjoyed our conversation. Like, where can we send our audience? Where can they follow more of your work?
Both LinkedIn and Twitter. Jaime Carrasco. Twitter's where I'm always making comments, especially market comments. Like right now, I'm preparing something for quarter end. There's been I was thinking that maybe prices were going to pull back. I'm sitting on a bit of cash. I'm not ready when to deploy, but that's where I make all my comments. LinkedIn is a little bit different because but those are the two places. And anybody, I'm always happy to chat on the phone. Jaime, Jaime, at jcwealth.ca is our email, but we're with Harbourfront Wealth.
Fantastic. Jaime, really appreciate you coming on. It was a great chat. Really enjoyed it. We'll have to get you back on. We're getting the quarterly financials here at the end of July by most of the producers, so we'll have to catch up probably September, October and see what they are. And maybe I'll run into you at Beaver Creek or any of the conferences.
I'm going to be at Beaver
Then I'll
Creek.
see you there. I'll see you there for sure. So I'm looking forward to that. Jaime, thank you so much for coming on. Everybody else, thanks so much for tuning in to Soar Financially. Hope you enjoyed this conversation with Jaime Carrasco. Make sure to follow him on LinkedIn and on X, of course. And if you enjoyed this conversation, leave a like, leave a comment, and follow us. It's a free way to support our channel. It's just by hitting that subscribe button. We tremendously appreciate it, and we'll be back with lots more here on Soar Financially. Take care out there.